What's up, millennials? In exchange for about 10 minutes of your time today, we're going to take a look at the valuation of Electric Last Mile Solutions, ELMS, and that company is going to be acquired by the SPAC under the ticker symbol FIII. Before we start, a few things. First of all, I have not done extensive research about this company just yet. We're just going to take a look at the valuation according to the company and the SPAC themselves. Secondly, don't trust me, verify me, I'm just documenting my journey here and I'm not a financial advisor. Third, Stock O'Clock. These are very short 1-minute videos that I post every single trading day with news about the stock market. And lastly, Discord. If you want to join my free Discord, please go to nesami.com/discord, leave your name, leave your email address, and you'll get access to it. So let's first of all give you a very short introduction of this company. I'm just going to call them ELMS for short. I believe it's just ELMS, but ELMS sounds just a little bit better and it rolls off the tongue a little bit easier as well. So ELMS is an electric vehicle company. They make electric vans for urban delivery. And it's actually quite an interesting company. This company is a spin-off from a Chinese automaker called SOCON. And the thing is, there are some interesting things about ELMS. First of all, they already have a plant in Indiana which is retrofitted for EV production. They are about 90% ready for US production as well, and they have access to trained workforce of over 400 people. Interestingly, also, they can actually get body parts from SOCON, so like their bigger brother, so it looks like they can scale up in a very short amount of time. Apart from that, ELMS already has more than 30,000 pre-orders up there, and yeah, that will cover their revenue up to about Q1 of 2023. Then now let's dive into the pro forma valuation first. So as almost all the SPACs, they are using a base share price of $10 per share, and we can see that they are going to have 142.5 million shares outstanding after the merger. So that means we can already calculate a pro forma market cap by taking that share price of $10 per share, multiplying it by the amount of outstanding shares after the merger, and that is going to give us a pro forma market cap of $1.4 billion. Then we can also see that they are going to have $379 million on cash on their balance sheet, but they're also going to have $150 million in debt. So if you calculate that, 379 minus 150 gives you $229 million in net cash on their balance sheet. So that's the number that I put over here in my Excel sheet. And then you can already determine the enterprise value. So basically the value of ELMS, the company itself, right? By taking the market cap of 1.4 billion, we just calculated that, and then you take off the amount of net cash, which is almost 0.2 billion, and then you're going to arrive at an enterprise value of 1.2 billion. So basically, based on a share price of $10 per share, ELMS would be worth $1.2 billion. However, if we go into trading view, we can see that ELMS right now, or FIII rather, is right now trading at $12.50. So that's a number that I put over here. So now we can calculate the changed market cap and changed enterprise value, right? Because the previous numbers were based on a share price of $10 per share. So with a price of $12.50 per share, the pro forma market cap is going to be $1.8 billion and the pro forma enterprise value is going to be $1.6 billion. Then the question becomes, but what is a fair enterprise value for this company, for ELMS? Well, ELMS, the company itself, and the SPAC have helped us out a little bit here. They compared themselves with similar companies out there. We're going to use actually two different methods for this video today, because ELMS and the SPAC also use two different methods, okay? First of all, we're going to calculate an enterprise value based on the revenue that they are going to have in 2024. That is the year that we are going to be looking at today, 2024. So we need two things for this. First of all, we need a predicted revenue number, and we need a certain revenue multiple. Let's first talk about that revenue multiple, okay? So ELMS has compared themselves with companies that are similar to their own company. Companies like Arrival, Canoe, Fisker, Hyliion, Lordstown, and Workhorse. And they were looking at their multiples. So they were looking at what kind of multiples these companies are trading right now. Or actually not right now, I believe these numbers are from December 2020, so just 1 month ago. And they saw the following. They saw that in 2024, Arrival was trading at a revenue multiple of 1.3x if you look at their numbers from 2024, right? For Canoe, it was 3.3x, for Fisker 0.3, Hyliion 1.1, Lordstown 0.4, and Workhorse 2.2. So then they say, all right, those numbers seem pretty reasonable. We're going to give ourselves a range of 1.2 for the low end and 1.6 for the high end. So we now have our range of revenue multiples, 1.2, 1.6. What about that revenue number from 2024? Well, they expect to have a revenue of $1.9 billion in 2024. So now we have our two numbers. First of all, the revenue multiple, 1.2, and we can now multiply that by the revenue of 2024, right? Which is 1906. So that is going to give us an enterprise value of about $2.3 billion, $2.2872 billion, which is also the number that I put over here in my Excel sheet. We can also do the same thing for the high end because we just used the low variable, 1.2. Now we're going to use the high variable, 1.6. So do the same thing, 1.6 times 1906 gives us a high valuation of a little bit more than $3 billion, okay? $3.0496 billion, which is the number that I put in my Excel sheet over there as well. So now we can also pull this up. Let's go. So we have a low valuation of about 2.3 billion, a high valuation of 3 billion. We can now say, okay, let's look at the average of these valuations, which we're going to call the midpoint valuation. And the midpoint valuation in this case is going to be almost $2.7 billion. Then we can go a step further and say, okay, that is the enterprise valuation, right? But first we want to go to a fair market cap. Well, in the beginning we said enterprise value is market cap minus net cash. So if we go to the market cap, we need to take the enterprise value, add the amount of net cash, and get to the market cap. If we do so, we see that for the low end, the fair market cap is going to be 2.5 billion. For the midpoint valuation, 2.9 billion, and for the high valuation, 3.3 billion. We can now take these market caps, divide them by the amount of outstanding shares after the merger to arrive at a fair price per share. Because we said that the amount of outstanding shares is going to be 142.5 million shares. Okay. So that is going to bring us to a low fair price per share of $17.66. A midpoint fair price per share of $20.33, and a high fair price of $23.01. Awesome, so that was method number one. Let's now take a look at method number two, which is not going to include the revenue, but we're now going to take a look at the EBITDA numbers. It's actually funny, some people say EBITDA, some people say EBITDA. I used to say EBITDA, but now I'm trying to say EBITDA, so yeah. Sorry. Okay, let's go to the EBITDA numbers. We need two things for this as well. First of all, we need the EBITDA numbers and the EBITDA multiple. Let's first take a look at those multiples. We're going to do a very similar thing as with regards to the revenue multiple, right? They looked at exactly the same companies, Arrival, Canoe, Fisker, Hyliion, Lordstown, and Workhorse, and they looked at their EBITDA multiples of 2024, which ranged from, 5.7, we see 25.4, we see 1.7, 3.8, 3.8, and 16.4, right? So we have a quite big range of EBITDA multiples. Let's now take a look at what ELMS thought would be a nice EBITDA multiple range to have. They said, well, we are going to give ourselves a range of 6x on the low end, 8x on the high end, okay? So we now have our EBITDA range, 6x, 8x rather. Then the other number we need is the EBITDA of 2024. And they say, well, we believe our EBITDA is going to be $465 million in 2024. So we can now do the calculations. We can see, okay, 465 million in EBITDA in 2024 multiplied by 6, the low multiple. That is going to give us $2.79 billion for the low valuation, right? We can now do exactly the same for the high valuation. So 465 million multiplied by 8 gives us a high valuation of $3.72 billion, okay? So let's make this a little bit bigger. And then we have these two numbers, and let's now take a look at what the midpoint valuation is. Well, the average of these valuations is $3.3 billion more or less. Now let's do exactly the same thing. We're going to take these enterprise values, add the amount of net cash. We're going to do it a little bit quicker now. We're going to arrive at these market caps. So 3 million for the low end, 3.5 for the midpoint valuation, 3.9 for the high valuation, divided by the amount of outstanding shares, gives you these share prices. So $21.19 for the low end, $24.45 for the midpoint valuation, and $27.71 for the high valuation. So we've now looked at two different methods to value this company. And I thought it would actually be nice to take the average of these two valuation methods to just see what kind of price we end up with, right? So far we haven't taken a look at only the revenue methods, the valuation methods rather, of ELMS and the SPAC themselves. But now we're going to go a little bit more subjective and we're just going to take a look at an average price of both of these methods. Cool. So the average price for the low end of both valuations is $19.42. The midpoint average price of these two methods, $22.39. And for the high valuation, $25.36. Okay, so there you go. The average midpoint price per share of both of these methods is $22.39. And that would mean that FIII or ELMS is right now undervalued. But as always, keep in mind, don't trust me, verify me. I'm just a random dude on the internet. I'm not a financial advisor. And also take into account, we have been taking a look at certain assumptions. We have taken a look at revenue numbers and EBITDA numbers that are provided by the SPAC and the company themselves. We have applied a certain multiple to these variables. So that means that if you change one of these numbers, the entire calculation is going to change as well. And that means that your fair price per share is also going to change as well. I hope this video brought you some value. If it did, please consider sharing this video with your friends who are also investing in the stock market and in SPACs. And with that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye bye.